Welcome to Yahoo Finance Live, and happy Friday to all of you. I'm Akiko Fujita. We've got 1 hour left to go in the trading week. Let's take a look at the market action right now. A bit of a split picture here. The Dow pretty flat right now. The S&P 500 up 14 and the Nasdaq up 76 as investors react to that all-important jobs data that we got this morning. In terms of sectors we're watching right now, energy, the big outperformer on the day with oil prices notching a 6-week high. We've seen positive gains in materials as well as financials as well. Of course, we have been watching the moves in the bond yields very closely today in reaction to that data from this morning. The 2-year yield falling after hitting a 16-year high on Thursday. The 10-year yield trading pretty flat right now. Well, U.S. employers pulled back on hiring last month with the latest jobs report pointing to 209,000 jobs added to payrolls in June. That number came in below estimates, but the unemployment rate fell to 3.6%, while hourly wages increased by 4.4% year on year. And you saw the reaction that we've been seeing in the markets right now. With the labor market still relatively strong, there is a growing expectation the Fed will move forward with another rate hike when the FOMC meets later this month. The Biden administration calling today's report a win, though, saying it is all part of the new Bidenomics plan. Labor Secretary Julie Su speaking to our morning team earlier today. Take a listen.
We see continued growth, and combine that with the 3.6% unemployment rate, which, for the last 17 months straight, unemployment has been less than 4%. It hasn't been like that since the 1960s. And so those combined figures really demonstrate that President Biden's economic policies are working. And what we do want is that steady, stable growth as represented by today's report.
Let's bring in Joe Brusuelas, chief economist at RSM. Joe, it's always good to get your perspective here. I guess a bit of good news and bad news in this report, right? On the one hand, we saw hourly wages go up. We saw unemployment tick down. But we did also get 2 revisions to the downside from the previous report and a bit of a slowdown, at least in hiring. Are we starting to see the turning point here?
Well, I think that the labor market is cooling relative to an unsustainable and overheated pace that we saw. I think the big takeaway here is that American labor dynamics remain quite robust. Not only did we add 209,000 on the month, you take a look at the first 6 months of the year, 1.77 million jobs added, an average pace of 296,000 per month. I get the sense that as the economy moves into the second half of the year, you're going to continue to see that to moderate, and that in and of itself is probably some good news, especially over at the central bank, where I think we're approaching what I think will be the peak in the current interest rate cycle, and that's undeniably good news. That's why I saw the markets move up today.
Yes, we are potentially approaching the peak, and yet the question appears to be what happens beyond this upcoming meeting, because there is an expectation of another rate hike baked in. Based on the data we got today, what does that tell you where we are, at least in the labor market right now?
All right, so right now in the labor market, we're in a situation where rising wages are bringing people off the sidelines. When you take a look at the labor force participation rate overall, we had a multi-decade high. It hasn't been this high in over 20 years, right? Labor force participation rates of females aged 25 to 54, 77.8%. I mean, it's really very, very strong when you look at that prime-aged workers. As we move forward, there's going to have to be a policy conversation around where are we going to find the workers to rebuild the infrastructure and revitalize our manufacturing sector. You know, when I take a look at this, it's very clear that there's four things that are going to need to be addressed. The first is wages are going to continue to rise to bring people off to work, off the sidelines. Second, workplace flexibility is clearly part of the new labor force. That's not going away. Firms are having to adjust to that. And this is where it gets tough. The heavy lifting will be around immigration and then quite possibly childcare. But you know what? When you have a confluence of conditions like we have, where we just don't have enough native-born workers to fill the need, there are 10 million job openings out there still. We're going to have to get creative here. That, to me, is the underlying narrative of, again, a very robust American set of labor dynamics.
Yeah, and we've heard concerns, particularly in the services sector, especially in terms of not being able to fill those jobs that are out there. I wonder what you make of this other thing that we saw in the report today, which is how many more employees are now part-time workers. In other words, a lot of those hours that they had to work were pulled back because of economic conditions, at least according to the report. What does that tell you about how businesses are operating right now and how big of a cool down we're seeing right now?
All right, well, that's a great question. When you take a look at people who are working part-time, what it really illustrates is that we have a cohort of people who would like to move into full-time work but can't. They need a very heavy dose of workplace flexibility. U.S. corporations, my firm, my clients, the clients of my firm, that's what we hear is they're trying to provide maximum flexibility to retain and recruit individuals into the workforce. And that's why I mentioned things like, higher wages, workplace flexibility, and then, we're going to have a talk around childcare and immigration going forward so that we can get those people back into the workforce on a full-time basis.
You look at the data today, you look at what we got in terms of the latest inflation data, it feels like everything is tracking at least in the right direction. And of course, that raises the question about whether, in fact, this soft landing can be achieved. It feels like we're increasingly hearing about a potential for a full employment recession.
Okay, so yeah, full employment by my estimation is at 4%. We're sitting at 3.6% as of the June labor force report. Okay, so when you take a look at the underlying fundamentals, let's say you're out there, you're trading, you're investing, and you're thinking, what's the second order derivative here? That's the rate of change of the rate of change. That's slowing at an increasing pace. That's aligned with a good chance for a possible soft landing. I think that's around 40% right now in terms of overall probability, and that's non-trivial. That's something to hang your hat on at this point, given the twin inflation and interest rate shocks that the economy's absorbed over the past couple of years.
So you put it all together, a rate hike expected in July. Are we going to see a
without
second
a doubt.
one?
Yeah, well, that will depend on the evolution of the inflation data. Next week, we're going to see the CPI data released. The top line's likely to have a 3% number on it. So the public, which follows CPI, political actors who follow CPI, many firm managers who follow that, at a certain point, they're going to stop planning on raising prices because they expect inflation to continue to increase. In fact, I'm beginning to hear that from clients at this point. So, and we know from the best research, which tells us that once inflation gets between 3 and 4%, they really don't care about it. Now, that doesn't mean the central bank won't, nor should they. Economists like myself would counsel we need to move forward, but with caution, because inflation, that is services ex housing, which is the policy-sensitive metric that the central bank's now following, that tells us it's still not coming down at a rate that's acceptable or tolerable. So there is some heavy lifting to do, both in terms of communications at the Fed, who's going to have to tell the public why they're lifting rates, even though inflation's at 3% and will likely have a 2 handle by the end of the year, and then why they need to restore price stability and why they have to focus on that particular metric, services ex housing.
Okay, points to still a bit of a noisy outlook there. Yeah. Joe Brisquelas, as always, good to have you on, Chief Economist at RSM. Well, even with a slight cool down in hiring, the White House says today's report points to Bidenomics in action. The president saying in a statement, the latest economic data points to stable and steady growth. He's been touting his policies, crisscrossing the country as he ramps up his re-election campaign. Let's bring in Yahoo finance columnist Rick Newman. Rick, I guess we could say he's already in campaign mode here, but is the data today a win for the administration?
Yeah, it is. Today's data is good, and Joe Brisquelas just laid it out very well. One thing I think you could add is wages are now growing by more than inflation for the last couple of months, which means after falling behind inflation, typical workers are now starting to get ahead. Biden is absolutely running for president, but as much as he's going to brag about the economy today and the economy he thinks we're going to have in the future, what he really cares about is the state of the economy, let's say 1 year from now. And you just can't help but wonder, is this slowing pace of job growth that we saw in June, which is stable and, normalizing, But is that the beginning of a slowdown that could end up being a recession? And if it is, the timing would be terrible for Joe Biden. So, I mean, we've talked about this so many times, Akiko. Economists have been thinking we're going to have a recession. There's always a recession 6 months out. They're looking at the leading indicators and other data and what the Fed is doing with interest rates and inflation, saying there's no way we're going to get through this without even a mild downturn. If that was going to happen, what it would have been best for Biden is let's have a mild recession in 2023, get it over and done with, so that we are in a recovery by the time people are deciding whom to vote for next year. Well, if this just gets delayed into 24 and we have the downturn in 2024, that would be bad news for Biden. So I don't want to be one of those people who's always saying a recession is coming 6 months from now. But when you start to see the actual numbers slowing down, you just have to wonder, is the curve just going to straighten out like this, or is it going to turn and go like that?
Well, and you'd imagine that that's what Republicans are hoping for. Let's go across the aisle. How do they spin today's report?
Well, they don't want to talk about jobs. They want to talk about inflation, and they have been talking about inflation. So we know that Joe Biden now embraces this phrase Bidenomics, which we've been using at Yahoo Finance ever since he became president. But that used to be a pejorative. Republicans used to say Bidenomics. That means high inflation and recession around the corner. Well, Biden says no, it doesn't. It means super strong job growth, and I'm pumping literally trillions of dollars into the economy to transition over to green energy and so on. So I think Republicans are going to run out of runway by criticizing Biden for inflation. I mean, you just again heard Joe Brusalis say the next inflation report is probably going to be below 4% on a year-over-year basis. And if we get inflation below 3% by the end of 2023, as he suggested, well, what inflation do Republicans have to run against? I mean, inflation could very well be completely back to normal by this time next year. But, you know, we should not forget the lag in monetary policy is between 12 and 18 months. The Fed has already hiked interest rates by 5 percentage points at one of the fastest paces ever. And we do not yet know the effect that's going to have on the economy. So stay tuned.
That's certainly a good point, although we have seen the administration increasingly owning that Bidenomics label. Rick Newman, thanks so much for that. Have a good weekend.
See ya, Kiko. Bye.
We're just getting started here on Yahoo Finance Live. Coming up, the wealth effect is driving the way investors view stocks. We're getting technical and breaking down what's driving the latest market action. Plus, shares of Alibaba are soaring today after Chinese regulators hit Ant Group with a near $1 billion fine. We're going to discuss why that's providing some relief to the tech giant later in the hour. And Major League Baseball's All-Star Game set to take place in Seattle next week. I'll be speaking with the Mariners president, Katie Griggs, later in the show. All that and much more coming up here on Yahoo Finance. We'll be right back. Well, investors are shrugging off a weaker than expected jobs report, with the S&P 500 at least in positive territory going into the end of the trading week. All three major indices still headed for a week of losses, though. Our next guest says the market is headed for a fast and furious correction after big gains in the first half of the year. Let's bring in Jeff Bierman, TheoTrade Chief Market Technician. Jeff, we're going to get to the technicals in just a bit, but I'm curious to get your read on the market reaction to this data today. You know, on the one hand, we've been talking so much about investor concerns around additional rate hikes coming, and yet here we are today talking about a jobs report that essentially cements another rate hike come July, and the market's just taking it in stride.
Well, you know, it's a tug of war. The market's trying to figure out, is it going to be 2 rate hikes before the end of the year, or is it going to be 1 rate hike before the end of the year? So it's 92% chance as of today that they're going to raise rates at the end of July. But if the economy can cool off at a reasonable pace, which it showed today, because we've gone down from a jobs report of 306,000 in May to 209,000, that's a tolerable number for the Fed to kind of deal with. So the market's trying to come to grips with, is it 1 rate hike or 2 rate hikes? And if it's 1 rate hike and the Fed pauses, the market might construe that as saying, well, we finally peaked and it's time for us to take off and start buying and make a move higher, leg higher, and break out from this 4,400 level. So I just think the market's sort of in between this hem and the haw, trying to figure out what's going on. So the immediate jerk reaction was to pull back and then to steady the ship and then to come back and rally, because it's not that bearish, but then again, it's not that bullish. So indecision leaves it where it's at. You can see that on the tape today.
Let's talk about where things are headed now in the second half of the year, because you've laid out this narrative for the market, the lifestyles of the rich and famous. Break that down. What do you mean by that?
Yeah, ode to Robin Leach out there, if you can remember far back as I can. But listen, there have been 3 sectors driving the market for the better part of this year, and for good reason, Akiko, good reason. The tape has been strong since January. It's the wealth effect. I mean, the market becomes an ATM machine to a lot of retail traders, even a lot of institutional traders. So it's been driven by technology, it's been driven by leisure, and it's been driven by travel and lodging, which includes airlines and hotels. So if you can see, people are feeling it. They're not really out there saying, well, let's go to the discount merchandiser, or let's go to Costco or Walmart. Those things have actually been running in place. And even some stocks, they were tagged, like Levi got nailed 5% down today because, you know, the average person's not out there shopping for clothes. People are shopping for big ticket items, Akiko. So you're seeing the big runoff. And let's say, I've got to own a new iPhone. I got to take a trip to Greece and I got to fly on United, and I'm going to grab myself a Norwegian cruise or Royal Caribbean cruise out in Greece, and I'm going to buy myself an expensive watch. People are spending based upon how wealthy they feel based on the backdrop of the market. But the problem with that is easy come, easy go with psychology, because we're so overheated in these particular famous lifestyles of the rich and famous stock. I mean, they've overshot so horribly that when they start to come down to earth, it could create a very fast and furious correction. I'm not calling for a meltdown. I'm just calling for get ready for what could be one quick drop back in the market, and then maybe a quick bounce back. So be aware, Royal Caribbean, Marriott, United, they've all way overshot their expected moves. They are trading outside 3 standard deviation channels, which is just very unusual. And they just haven't seemed to give in just at all because of the performance chasing by investors who've reaped the benefits of the market in these 3 sectors.
Well, you could argue that we're already starting to see some of the cracks in those trades you just pointed to, particularly on the tech side. But what do you think is going to be the big catalyst that moves that chart to the downside?
I think one of the things that you saw today, and it's very subtle, and it's where I've positioned myself, is in oil. Oil's been a lagger all year long. It's like people just don't want to touch it. But oil's more or less a function of supply and demand with OPEC, and OPEC has been consistently cutting. But if the demand side can come up to meet it, that could put upward pressure on inflation. The Fed will look at this and say, oh, you know what? If there's upward pressure on inflation from raw materials, that could restrain investor spending, and that could pull back the market and start to get those high-tech stocks and also the leisure and lodging stocks rolling down, because the rotations will start towards more of the lagging value plays away from the high octane, high multiple growth plays. So I think it might be some unexplained pop in oil or raw materials that could get people on their heels.
Bond yield certainly a good indicator of where things are headed, at least in the macro picture. We saw a bit of a pullback today on the shorter end of the yield curve on the back of the jobs report. But what's the big number that you're watching right now that could signal?
I track the inverted yield curve
pullback?
I track the inverted yield curve as much as anybody does here. But I think when we start to get to that 4 or 5 handle on the S&P, on the 10-year Treasury, it's going to start to get toppy at that point. I don't think the Fed wants it to go beyond a 4.5 handle. So they're going to be very careful to, be data dependent, read the data, ratchet up interest rates. But I think there's a restraining number at around that 4.5 handle on the 30-year Treasury. So I would keep that in mind. That should be the next step, leap forward as we start to move up. And if we can take that out, the 4.5, that will definitely put pressure on the high multiple stocks. That will definitely do that. But if we fail at the 4 or 5, that actually will be bullish for stocks, because we'll indicate at that point the Fed may be done with its raising rate type of program.
So the second half of the year, you say a fast and furious correction. What's the defensive play? Where do investors hide out? What sectors?
One place that's been lagging horribly is pharma. Some of them trade at single-digit multiples. Things like Pfizer, which has just been left for dead, Bristol Myers, which has been avoided like the plague. Today, Merck is coming down. Merck got hammered today, but for good reason. Merck trades at a very high multiple. But I do think healthcare is going to be a place to park your money in the second half of the year, Kiko. And on the same note, I think you're going to be able to park your money in energy stocks. The yields are phenomenal. The PE ratios of the average oil stock are in single digits, which I haven't seen for a very long time. So I've shifted a lot of my funds, tactical asset allocation, towards energy and towards healthcare. And it's away from tech and away from travel and leisure. So I think the market will start to even itself out, starting as we move seasonally into that August, September, sort of that boogeyman seasonality timeframe. So be aware that this overbought condition will eventually be worked off. It's just nobody's going to ring the bell when it happens.
Some good takeaways there. Jeff Bierman, TheoTrade Chief Market Technician. Appreciate the time today.
Thank you very much for having me.
Well, coming up, Alibaba shares rallying despite Chinese regulators punishing its sister firm Ant Group with a hefty fine. We're going to explain what the latest move means for the e-commerce giant when we return. Well, stocks wobble as investors try to shake off a slightly weaker than expected June jobs report, while the major averages head for a week of losses. So where should investors look to invest and where should they stay clear? Here to discuss, we have Freedom Capital Markets Chief Global Strategist, Jay Woods. Jay, we're going to start on where to steer clear, because that's kind of where the conversation has been going for the last few days. I'm looking at shares of Meta right now, up slightly today, but we saw huge gains yesterday on the back of the release of Threads. 30 million people downloading the app. What's not to like?
Yeah, it's amazing. The stock's up 142% year to date. Threads seems to be a hit right out of the box. There are 2 billion subscribers on Instagram that can easily switch over to it. But I don't know if you got to check it out. I wasn't really impressed. I don't know if that's going to last, if it has the momentum. It is a great story, but I like to look at the price action in this stock. We've come pretty far, pretty fast. It was beaten down last year. It filled a major gap to the downside from Q1 2022, and it looks like it's tiring. There are a few things I'm seeing in price action that tell me it may be time to pause and it may retreat from here.
What would be a comfortable entry point for you when it comes to Meta? I mean, you could certainly argue that, look, maybe Threads didn't blow everybody out of the water, but it feels really opportunistic when you think about where Twitter has struggled if Meta hadn't seen such a run-up going into the launch.
Yeah, you know, this could be one of those buy the rumor, sell the news kind of events. For me, I think a natural pullback is in order for a stock like Meta, given the run-up we've had. It's so far above all its major moving averages. A 10% correction, which would put it down around 260, would come right back in line to a 50-day moving average. It hasn't touched it in well over 8 months. These are levels where I could see a natural pullback and the stock's still in a majorly uptrend. And then you talk about rotation in this market. Here's a sector that's been hot. I'm watching the 10s and the 2s. If the 10-year stays above 4%, if the 2s stay above 5%, and they're borderline right now, and they gain momentum, they break out to 50 yearly highs, that could draw people away from these magnificent 7 stocks and put stock to work in other defensive sectors.
Okay, another stock you say to stay away from, Starbucks. 2 key issues you've pointed out here: commodity prices and a potential pullback in consumer spending. What's your concern?
Yeah, my concern is twofold. One, we're talking about consumer spending habits going forward and the student debt coming back into play September, October. And I've had conversations with my Gen X kids, people that go to Starbucks regularly. What's going to get hurt? Consumer discretionary. Where is an easy place to cut? It's Starbucks. And then if you look at another headwind, you look at the commodity price of coffee itself. It had a nice little reversal the other day. Prices are starting to go back up. That could hurt margins going forward. Do they want to raise prices if coffee commodity prices go higher in this environment? I don't think so. And then more importantly, I look at the technicals. I look at the price action, and it's got me a little concerned.
Let's talk about the positives here, some of the stocks that you like. Generac, specific one that you've highlighted here. We spoke with the CEO of Generac earlier today on major temperature shifts and its ripple effect. Take a listen.
The last 2 decades, you could argue, we've really seen a lot more outages, and a lot of outages are driven by weather. I think what's changed here more recently, and as we think forward here and as we look to the future, is the extreme temperature swings. Those types of extremities in terms of temperature swings are really having a major effect, frankly, on the stability of the grid. And this is really a broader discussion of the evolution of the grid as we work to decarbonize the sources.
So Generac CEO, they're saying that, look, some of the temperature or just climate impact is a positive for Generac. Is that the reason for you getting in on this stock? What are some of the other potential drivers?
There are 2 reasons. 2 reasons. One, spot on. I mean, the hottest day in the history of the Earth in the last 2 days. But I look domestically, I look at the outages we've had in Texas, and that caused people to go out and buy Generac generators. They need to power their houses. And then also, it's hurricane season. I don't know if you got to go to the ocean this last week. Here on the East Coast, the temperatures are really hot for this time of year. That's not good for people concerned about storms brewing as we get later on into the season, August, September. So historically, Generac has done well in strong hurricane season, and unfortunately, that's something we're looking at. And then price action, wow. This was the worst performing stock in the S&P 500 last year. It has a lot to reverse. First, what did it do? It broke a long-term downtrend of about a year. It stopped going lower, one. It started basing going sideways, making constructive higher lows along the way. And then what happened? In May, after its quarterly report, it gapped higher, broke out of that major downtrend above key moving averages, and it's starting to make its way higher. It has a lot to reverse. Yes, it's been having a good year to date, but it has some resistance at the 150 level. It just flagged, gave investors a nice entry point over the last few days. But I think this stock goes back to 150, and seeing where it's come from, I don't think 200 is too far out of the cards either.
Finally, Jay, a sector play here, specifically what you like, industrials. What's the upside there?
The upside is great. This is a sector that, if you look at it on 2 time frames, when I look at charts, I look at multiple time frames. On the daily chart, it just made 52-week highs. It broke above this level, 103, 105. This is constructive price action. And let's back out. Where is it coming from? It's been in a base where it's failed to get above 105 several times now, going back almost 2 years. It's above there right now, 107. It got above there, it flagged, it tested the old resistance level, which hopefully is now support. Other thing I see, MACD crossovers. I don't know if we have a chart of the MACD crossovers on a weekly basis, but in the last 5 years on a weekly chart, we've had 6 positive crossovers. We just had a 6th a few days ago. Every single time, the index has gone up a minimum of 8%. So based on the 103 level where we saw that MACD crossover a few weeks back, it looks like it has a lot to run. It went 112, 115 easily. Plus, it broke out, so it's got a lot of momentum. And they say the longer the base, the higher the space. And I believe that as we rotate out of some of the mega caps, industrials is a sector I like. The stocks leading the way, the GEs, the Lockheed Martins, and Northrops. Watch Boeing. Boeing's about to go as well. If Boeing goes, the sector goes higher.
A lot of investors looking to move out of tech. Taking note there, Jay Woods. I appreciate your time today. Thanks so much for joining us.
Thank you.
Well, Tesla inching closer to having an industry-wide universal plug after Mercedes announces it will be the first German car maker to implement Tesla's charging plug. Here with the details, we've got Yahoo Finance's Pras Subramanian. Pras, it was only a few weeks ago when we were saying that Tesla is setting the North American standard. Now you've got at least one German car maker on board. This is a global conversation.
Yeah, add another partner or scalp to Tesla's list of new companies joining their supercharger network. Now with Mercedes in 2024, Mercedes will have access to 12,000 supercharger stalls in the U.S. and North America. And in 2025, Mercedes will add the Tesla NACS port to its own cars, meaning they'll have native access to the supercharger network. So this is sort of similar to the deals that they're making with GM and Ford and even Volvo. The one little wrinkle here is that Mercedes, they had already previously announced a bespoke charging network, the Mercedes network. They're now going to add the Tesla NACS plug to that network, so that's kind of a big deal too. They were really going all in on that standard. So another big kind of partner here for Tesla. Like I said, Germany's first original equipment manufacturer to do this, and we might hear from Hyundai and also Volkswagen. They're also rumored to be speaking to Tesla too.
Meantime, Pras, Tesla has been very aggressive in getting additional customers on board. They're out with even more incentives. What's the very latest there?
Yeah, so Tesla restarted their referral partner program about a month or two ago. They had it for many years before. Basically, what happens is if you use a referral link from a prior owner, you will get some incentives here. In this case, new buyers will get $500 in off their purchase price and 3 months of FSD self-driving capabilities there. And also the person who is the referrer will get 10,000 referral credits, which can be used for supercharging points, Tesla merch, things like that. So now referral links are everywhere. You don't need to actually know a prior owner to get a link. You can get one online anywhere, so not a big deal. So, but the big deal here, I mean, the bottom line here is that this isn't a big sort of mover like a massive price cut is for a Tesla vehicle, but it just kind of goes to show you that incentives matter. People like these things, and Tesla really wants to sort of keep growing those delivery numbers into Q3.
All right, Pras Subramanian with the latest update on that. Thanks so much. Well, shares of Alibaba are rallying today after Chinese regulators slapped Ant Group with a $1 billion fine, the fintech firm has faced heavy scrutiny since officials forced the company to scrap its IPO back in 2020. The fine today seen as a potential sign that Chinese authorities are wrapping up investigations into some of the country's largest tech firms. Here with more insight, we've got Brian McCarthy, Chief Strategist and Managing Principal at Macro Lens. Good to talk to you today. You know, even though we're talking about a rally, we're still well off the highs of the stock this year. What's your read on this fine? Is it really a wrap up, the end of an investigation? And to what extent does it clear out the air for a company like Alibaba?
Sure. So the rectification campaign has come to an end with regards to Ant Group. At least that's what they've told us. So no reason to think that's not correct. This was, I think, pretty widely anticipated. As you noted, Alibaba's sort of had a couple of rallies, one with the broader market late last year that failed as the China reopening optimism went by the wayside. Another in late March on the breakup plan. And then, you know, again today on what I think is just a continuation of this process of the completion of the Chinese Communist Party's goals with regards to the tech sector, which is to sort of the breakup of Alibaba is designed to ensure that that entity cannot achieve a degree of political and social power that would be uncomfortable for Xi Jinping. So, you know, the Ant fine brings that particular chapter to an end. The IPO will probably be rolled out in coming months, as will IPOs for the other segments of Alibaba as it becomes a smaller entity, effectively.
Yeah, I mean, so the regulatory crackdown, these investigations may be coming to an end, but if you talk about Alibaba specifically, this is a very different company that has emerged on the other end with the expectation of these spin-offs too. How do you assess it as a stock right now? Is it still the big e-commerce giant, the big play that includes cloud, everything? Or do you have to start to kind of take apart the pieces when you think about the valuation and to what extent it's a good investment?
Yeah, it's the latter scenario in my book. You have to assess the valuation of the six entities, add them up, and you know, come up with your number. You know, I'll leave that to the sort of the micro bottoms up equity types who do that kind of thing. But I think from a broader valuation perspective, what's been clear for many months now is that the Chinese tech space was not going to achieve the types of valuations that their counterparts in the US have, simply because they're not going to be able to monetize the data, because possession of the large volumes of data that the US tech giants enjoy confer on them a great deal of power, political power, power over you know, discourse in our society. That's just not going to be allowed to happen in China. So the whatever valuation premium, you know, U.S. Tech entities enjoy because of their ability to collect and monetize data, you're not going to have that in China. So, you know, you should view Alibaba as six soon to be independent businesses, some with better growth prospects than others, and that's sort of the bottom up analysis one would have to do.
Yeah, even with that said, Alibaba, even among the big tech giants in China, is especially exposed to the consumer because of the e-commerce play. And I'm curious how you're assessing that side of the business right now, given the latest economic data that's come out of China and the slower than expected pickup in the broader economy.
Yeah, I mean, I do agree with the analysts that say the stock trades very cheaply. I mean, the valuation is very low. But I have a very dour view on how the Chinese economy is going to evolve. You know, we're not going back to credit-fueled growth in China. Xi Jinping has sworn that off. He sees it as weak, as corruption-riddled, and you know, generating GDP by building bridges and tunnels and airports they don't need for the sake of generating GDP. That's over. That doesn't suit his agenda for China in the next 10, 20 years. They're not going back to that. Furthermore, the property market has busted. That's not coming back. The weakness in property, the big story in the last couple of months is it's very clearly spread to the first-tier cities. You're seeing serious weakness in Shenzhen, which is the tech hub of China, in Shanghai, and I think sentiment there is broken in a way that can't be fixed. So you're in a post-property bubble debt deflation scenario in which the Supreme Leader has vowed, I believe credibly, not to return to just pumping excessive credit to try to keep this, what to some extent was a Ponzi scheme, afloat. So you've got a serious downdraft in that economy, and really nothing on the horizon that I can see that turns that around. So that is a problem for the growth rate of Alibaba's consumer-facing businesses and for the Chinese market in general.
So if we're not talking about growth at all costs or growth on the back of debt, we're talking about a smaller footprint for companies like Alibaba. Are the Chinese tech names or the tech names, as we know it, the big tech companies, are they still good investments?
Again, the stock is very cheap, but I think they should be viewed as more prosaic investments than their counterparts in the rest of the world. You're just not going to enjoy the kind of growth. And again, it's really the monetization of the data. And in many aspects, innovation is state controlled in China as well. So they just don't have the room to roam economically, politically, technologically at this point that their counterparts in the US and elsewhere might.
Brian McCarthy, Chief Strategist and Managing Principal at Macro Lens. Good to talk to you today.
Thanks, Kiko.
Well, coming up, recent data shows that global VC deal making took a major hit in the second quarter, but could a turnaround be coming as a use of artificial intelligence growth? We're going to discuss on the other side. A new report points to a big pullback in venture capital deal making. PitchBook data shows the number of deals fell by 40% in the second quarter compared to the previous quarter. And it's down 42% when you compare the first half of the year to the same period last year. Let's dive deeper into the data. We've got Vincent Harrison, PitchBook venture capital analyst. Vincent, just walk me through the headlines coming out of this report. It's certainly not a surprise when you think VCs are also turning cautious right now on their investments, but the deal counts have kept up.
That's right, yeah. Thank you for having me. So basically, of course, as you mentioned, deal counts have somewhat kept up. But what's happening here essentially is that you're seeing a lot of deals still occurring. And what that's basically pointing to is the fact that there is this impetus to kind of put in extensive capital runway, but to also kind of like avoid dilution. And so a lot of companies are still able to gather funding, but you're not nearly seeing it at the volume or magnitude that we were seeing in 2021 and 2022. And so across all stages of VC, things are trending downwards in deal making. They've continued to trend downwards since the second half of 2022 and will likely remain that way through the end of the year.
When you look at the deal count specifically, to what extent have those been concentrated in artificial intelligence? We've been talking so much about the excitement in this space, but I wonder how you look at that number and then pull out AI and see where we are beyond that.
Yeah, absolutely. Of course, AI has been getting a ton of hype and craze thus far through the year. A lot of that, of course, off the back of the release of ChatGPT, success stories like self-driving cars, personalized recommendations and things like that have drawn a ton of attention to the space. But it's also important to remember that when we're looking at a lot of this data, there are your outliers. Of course, OpenAI, kind of brought up a bunch of deal value. So $22 billion in deal value in Q1 of 2023. Again, over half of that was generative AI technology as well as OpenAI. And so actually, if you extrapolate that out, what you'll see is that AI and investment in AI technologies has kind of followed the broader trend of the venture market, which has been a downward trend. And so again, we'll continue to see how that keeps up through the end of the year, but it is important to remember those outliers.
What do you attribute to even the pullback that we're seeing in AI? I mean, that's a pretty short runway if you consider where we came from in November when ChatGPT was first launched to now. If we're already seeing a bit of a pullback in investments, what does that tell you?
Yeah, I think for a lot of investors, what they're really looking through is for these breakthroughs in technology, these breakthroughs in research. And so AI is nothing new. AI has been around for quite a while, but what you are seeing is this garnering of public interest in AI technologies. And for a lot of savvy investors, what they're really looking for are these breakthroughs, particularly on the generative AI front. And so again, that's why companies like OpenAI are able to kind of command those large checks. But for a lot of older, mature organizations that are unlikely to have a research breakthrough, they aren't able to kind of command that capital that some of other organizations that are on the impetus of having a research breakthrough are able to.
What has all this meant for startups, particularly the late stage startups who maybe a few years ago would have considered tapping the public markets in a slowdown on the VC side? I mean, what does that exit strategy look like for some of those companies right now?
Yeah, it's tough. I mean, a lot of those organizations were priced in an environment where there was a lot of emphasis put on this growth at all costs. A lot of the multiples were put on that, and a lot of emphasis was put on that. I think right now what you're seeing is this kind of back to basics mentality where instead of looking at growth at all costs, what you're really looking at is path to profitability. How much free cash flow do you have? What does EBITDA look like? Some of those fundamental business metrics I think we're starting to return to. The exit environment, of course, as you know, is one of the worst that we've seen probably since the global financial crisis. Thus far through the year, roughly $12 billion in exit value in the US. If you were to annualize that figure, you come in under $250 million or $250 billion, $25 billion on the year, which again would be the lowest in the past decade by over $50 billion. And so I think what we're going to be looking at is a lot of these organizations are going to take the time to retool their business models and to innovate and really look for a path to profitability as opposed to growth at all costs.
And you talk about the tough environment in the public markets. Traditionally these companies maybe could have looked at potential acquisition too, but M&A is certainly not positive, at least when you think about the outlook and regulatory scrutiny. Can you talk a bit about how companies are thinking about their strategy moving forward in the face of this regulatory environment?
Yeah, it's definitely tough. Of course, the FTC and the Department of Justice have heavily scrutinized a lot of acquisitions or potential acquisitions, which worries, CEOs who may have saw that as an exit opportunity. Of course, being able to stay private is a privilege, and in order to do that, you do need to raise capital, either dilutive or non-dilutive capital. Right now, the fundraising environment for startups is really tough. It's an investor-friendly market. Investors have a lot of leverage at the table. Valuations are trending downward, and so the prospect of going back into the fundraising market to look for equity financing anyway could be a bit, worrisome. And so I think what we'll likely see is that a lot of these CEOs, if they're unable to exit either publicly or through an acquisition, are going to try to find sources of capital, potentially venture debt, for example, non-dilutive forms of capital, to extend runway until things pick up back in the exit environment.
Yeah, we've heard a lot of startups having to hunker down in this environment. Vincent Harrison with PitchBook, appreciate the time today.
Thank you for having me.
Well, Apple's reportedly planning the rollout for its $3,500 Vision Pro headset. And if you're looking to grab one, you'll have to book an appointment first. Yahoo Finance's Dan Halley has that story. Bloomberg first reporting this out. Dan, what does this tell you, or what more are we learning about the strategy of this rollout?
Yeah, Kiko, this really isn't kind of a surprise, really. I got to try on the Vision Pro back in June, and during the process where journalists got to go in and influencers got to go in and look at this, they had to use different ways of measuring your face, making sure that the spatial audio worked, and getting your prescription for your eyes. So when you measure your face, you are doing that for what's called the light shield. That's basically a piece of foam that's going to sit between your face and the headset itself and block out all outside light. And the purpose of that is to really encompass you in this device so that when you are looking at something that's virtual reality or augmented reality, you won't be seeing the light from the side, your periphery, come in, and you'll feel kind of more like you're a part of that experience. Then to do that, you're going to naturally need to scan your face. So it's not going to be very intuitive at first. I also had to go into a room where they checked my prescription. I happen to be wearing contacts, so I was fine. But if I was wearing glasses, I would have had to get a special pair of lenses. And that's also something that you may have to do in the store. At first, this is going to be a weird product for people to get. The idea of having to get a customized kind of face guard to block out that light, and then customized lenses. So Apple is going to, obviously, according to this report, be rolling this out to all stores. But at first, these kinds of experiences, these demos, and the kind of personalized experience of buying these and getting set up with them is only going to be a few of them. So I think it's going to be exciting for the first few people who are really, really looking to spend the $34.99 on this device. I think for others, it'll be some time before they start to actually get on board. And as this article pointed out, this is something that watch as well. So it's not unheard of for people to do this. You can actually go into an Apple store, or at least you could previously, I don't know if they still do it, and try on the AirPods. So to get a sense of, okay, do these fit my ear well? Do they not? I don't want to spend, the $100 something dollars plus to get a pair of AirPods or, AirPods Pro if they're not going to fit me well. So it's not unheard of for them to do this, but it's going to be a really bespoke process, I think, with this particular device.
Let's talk about the social media space, Dan. Meta back on top again with Threads, the most downloaded app, at least over the last few days. 30 million users is what we're talking about right now, or at least 30 million people downloading the app. What does this tell you about how Meta's thinking about Instagram/Threads in the strategy for their company's future?
Yeah, look, I think one of the things to keep in mind is that this is something where they could have launched it on Facebook Blue. That's what they refer to the main Facebook app as. Instead, they went with Instagram. And the key here is the demographic. There's more influencers on Instagram. Celebrities are more apt to be active on Instagram. It has a more engaged user base. And when it comes to a product like Threads, that's what you need. You need an engaged user base to keep the flow of information going. And so, Facebook, it's for an older demographic. It's kind of a catch-all now. I mean, if you go on Facebook and you look at the sidebar, it's like soup to nuts, everything that you can imagine. There's a marketplace, there's communities, there's this, that, and the other thing. It's kind of overburdened with capabilities. Whereas Instagram, sleek, you have your photos, your images, your stories, things like that. And so it's the younger demographic, it's the engagement, and that's going to make Threads more popular. And so that's why they're going with it, and really why Instagram is the app of the future.
Have we decided what we're calling Threads? Like a post? Is it threading?
I guess
To
it's
thread?
a thread, but isn't threading what you do with your eyebrows? I mean, I think, that's kind of weird.
I think it's still up for debate, but hey, it's only been 2 days. Dan Howley, have a great weekend.
You too.
Coming up, we get you set for the final closing bell of the week. Stick around. We'll be right back. That is the closing bell on Wall Street as we round out a shortened trading week because of the July 4th holiday. Let's take a look at the market action right now. Certainly investors still digesting that jobs report we got this morning, missing the mark here just slightly. All three major indices closing the week in the red. The Dow down 187 points, the S&P 500 down 12, and the Nasdaq down 18. Checking in on shares of Levi Strauss closing the day deep in the red here, down more than 7% after the retailer took a hit from a decline in U.S. sales, down 22% year over year. The company also slashed its full year profit outlook as it battles a difficult consumer landscape and climbs back from high inventory levels. Harmeet Singh, Levi Strauss CFO and Chief Growth Officer, joined Yahoo Finance Live this morning to discuss the future of the brand's direct-to-consumer and wholesale business. Take a listen.
Our direct-to-consumer business is today about, a little over 40% of our business. It was, half this a decade ago when Chip and I joined. And our slated goal is for this business to be the majority of the business going forward. We have great retail customers, and so the company is going to be a hybrid company from a channel perspective and actually grow, distribution with both customers. But the direct-to-consumer businesses represents the full expression of the brand.
It has been a bumpy ride for shares of Levi so far, with Levi shares down 15% year to date. We are also keeping an eye on Biogen and Eisai, those stocks closing the day in the red on news that the FDA officially approved the first Alzheimer's treatment. Yahoo Finance's Anjali Kamlani has more. on that story. Anjali.
That's right, Akiko. I know it feels weird to say that it's down on the news, but that's in fact what has happened today for both the companies in light of what is going to be a really long road ahead for ramping up utilization of this drug. So just to recap, they got the full FDA approval yesterday after an accelerated approval earlier this year. Medicare coming out and saying after this traditional approval, they will then open the door to coverage, which is what really everyone was waiting for in order to see just how much access this provides to patients. Meanwhile, the label does have a warning about irregular activity in the brain, such as bleeding and swelling, and that's something that patients will have to be warned about and look out for. Meanwhile, CMS has also set up a registry to ensure that patients are being monitored out in the real world, as we saw a number of these instances and adverse reactions during the trial. So that's sort of where the concern comes from for these stocks and why you're seeing them down on the news. Meanwhile, we know that analysts have sort of a mixed take on this. We heard from SVB Securities earlier today saying that they don't believe the label updates will impact the uptake of Leqembi, but to continue to expect a slow ramp up in 2023 and acceleration moving into 2024. Of course, we know that Medicare Advantage also plays a role in this. So when those insurers do get their numbers in and whether or not they consider that is also on the table. That's something that we heard from JP Morgan analysts who also talk about that impact to insurers, as well as a potential competition coming from Eli Lilly's drug that is also really close to the filing and approval stages. So they also noted that it could result in some incremental cost increases. And that's something that has been on the table for some time. The price tag for this drug, $26,500 a year. Meanwhile, we know that Medicare, the cost to Medicare alone could range anywhere between $2 billion to $5 billion annually. That's according to JAMA recently. So that has been a point of concern for really Congress as well as for these payers. What will authorization look like? Will there be barriers like prior authorization? And right now, the drug is a infusion, so that sort of limits, mobility or impacts those with mobility issues. So if it does move forward with an injection, then that is also another thing that can expand access. So all of these factors, as you can see, really are hampering the good news that came yesterday.
Yeah, as you said, Anjali, it still points to a very long road ahead for both of these companies. Thanks so much for that. Well, we are just days away from baseball's Midsummer Classic. MLB All-Star festivities get underway tonight ahead of Tuesday's All-Star Game, where players from every team and tens of thousands of fans will descend on the city of Seattle, who's hosting this year's game. It's the first time Seattle's hosted the All-Star Game in more than 20 years. And joining me now is Katie Griggs, president of the Seattle Mariners. Katie, you can count me in as somebody who wants to be in Seattle for the game. But, the All-Star Game has always been a big showcase for the team hosting, for the stadium hosting, but also for the host city. How big of a bump are you expecting?
This is such an amazing event for all of Seattle and the Pacific Northwest. The Mariners are somewhat unique in that we represent not just the city of Seattle and the state of Washington, but a 5-state region across the Pacific Northwest. And this really is a celebration of baseball, a celebration of softball, and to your point, a celebration of our city and region. So we could not be more excited to be welcoming guests starting today.
What can we expect in terms of the festivities for the All-Star Game? I'd imagine you've got some big partnerships as well with major companies in Seattle to really roll out the full experience.
That's exactly right. I think it's been a really fun lead up. We've been working on this for over 2 years, working with both public sector and private sector partners to really ensure that not only T-Mobile Park shines, but the entire city and region shines. So this is something where it's been a long path to get here. We're very excited for it. Now that Major League Baseball is here, there is nothing that we could be more proud of than have the opportunity to host tonight's game for the first time ever, the HBCU Swingman Classic, featuring athletes from HBCUs and all of their all-stars. It's going to be the perfect way to kick off an event. The weather is gorgeous. We're going to launch with some fireworks this evening, and it only goes from there.
It's been a season of a lot of changes for Major League Baseball, particularly around the length of the game. We saw that the pitch count, or the pitch clock, I should say, for example, implemented. Part of that was the MLB's attempt to try and get viewership up. It feels like that has been effective so far, but I wonder how you assess the changes that have happened so far in the first half of the season.
Yeah, no, to your point, I think there's been a very proactive effort by Major League Baseball and by all of the clubs to make sure that we're reflecting the game that we want to see and that more importantly, our fans want to see. And so with the changes that you saw this year, activity is up, to your point, ratings are up, fans are tuning in. It's been a lot of fun. Our athletes are enjoying it, our fans are enjoying it, and we're enjoying it because ultimately it comes down to how do we grow the game and make sure that everyone else can fall in love with it the same way we have.
How much of that, though, do you attribute to the changes, particularly the length of time for each game? Because, I mean, we were talking about this. Baseball is a long game. Before any of this happened, we were talking 4 hours for some games.
Periodically you're getting 4 hours, but 3 hours was not at all uncommon, to your point. And I think what you're seeing is roughly 30 minutes have been shaved off the game, but you're not taking away any of the action. And I think that's what fans and even our athletes and our players are responding to so well, is you're getting all of the really fantastic athleticism that you had, but you're getting it in a little bit more of a condensed package. And we recognize it's not just about share of wallet, it's about share of watch. People have a lot of things that they could be choosing to invest their time and their energy into. And we want to make sure that baseball is something when they're here, they're getting as much as they possibly can for that time and energy that they're expending and enjoying our game, enjoying our sport, and enjoying our team.
When you think about how viewers consume sports, that has certainly seen some changes as well. It's not just about TV packages anymore. It is also about the streaming side of things. We also know that there's a younger generation that is not looking at all the games, but sort of looking at shorter highlights. And that's how they're consuming games. And I wonder, when you think about trying to broaden out the reach of the Mariners and the fan base, how you think about the change in viewership habits there.
No doubt. It is definitely a media landscape that's evolved very significantly and continues to do so. As a mother of 2 young kids, I'm really aware that the way in which they choose to consume content is different than the way I did when I grew up. And so it's something that as we look to ensure that we're growing the game, we're bringing in that next generation, we need to make sure that we're delivering it to them in the way that they want to receive it. And I think it's not just about the games, not just about the condensed highlights, all of those really fun moments that are directly about the sports, but it's also about showcasing our incredible players, showcasing the diversity of our game, telling the stories, showcasing their personalities, and making sure that people can find something to bond with, find something to connect to, find something where they can see themselves in another person, and make sure that they're attracted to the game that way. Because we recognize, and sometimes it's all about the incredible plays on the field. Sometimes it's about the fashion. Sometimes it's about the fun, the camaraderie. Sometimes it's simply about going and having a good time with your friends. We want to make sure that we're relaying that and allowing our fans to experience it both here in the ballpark, but also, to your point, through whatever media platform that they so choose.
Finally, Katie, you were talking about the diversity of the game. In many ways, you have become the face of changing diversity within Major League Baseball. The first female president over with the Mariners. We've also got another female president with the Marlins as well. You've also got Kim Ng, who is the GM of the Marlins. I mean, can you talk a bit about the changes that we have seen in the face of baseball, even though it's still very limited? And how do you think that changes the conversation within the league?
I think it's a good thing. The reality is females represent 50% of our market, the 50% of our fan base. And so recognizing that we are all better off when we're looking at the world through different lenses and making sure that collectively we're pointing out each other's blind spots and we're doing everything we can to make sure that we're presenting our sport, presenting the game that we love in the way that our fans want to receive it. And different fans want to receive it differently. And so having people who reflect those different life experiences and backgrounds being part of the conversation is a good thing.
Katie Griggs, the president of the Mariners. Good luck with the All-Star Weekend. I'll be watching closely from afar.
Thanks so much
for joining us today.
Thank you.
It is closing time here at Yahoo Finance. Here's a look at what to watch next week. Some key economic reports to keep an eye on with a focus on the consumer. On Tuesday, we're going to get the June reading on retail sales. On Wednesday, the June CPI report, which will be a key inflation data point ahead of the Federal Reserve's July meeting later this month. Other data points to watch in the housing sector, existing home sales, and housing starts. And investors will be waiting all week for the start of earnings season. On Friday, the big banks start reporting second quarter results. We're going to be hearing from JP Morgan Chase, Citigroup, and Wells Fargo ahead of the open. Analysts will be watching to see how the banks recovered from the crisis in the spring. And we could be getting the first Wall Street review of Cava. The fast casual chain went public last month, and the stock is up roughly 80% from its IPO price. We could see the first analyst notes with recommendations on Cava shares since the quiet period ends for Wall Street firms that underwrote the IPO. When Cava went public, there were questions about its valuation, which now sits at $4.5 billion. That'll do it for me on today's Yahoo Finance Live. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great weekend.